You know that feeling when you watch the market hit these dizzying, fundamental new highs. You're looking at the screens, the momentum is just absolutely parabolic, the news is nothing but green, and you gotta wonder, who exactly is taking on all the risk way up here? I mean, somebody is buying, right? But that means somebody else is quietly selling. Welcome to this explainer. Today we're going to look strictly at the data to see who is actually left holding the bag at these market highs, and more importantly, how you can make sure it isn't you.
All right, let's dive right in. The core story of our analysis today revolves around what we call the commercial trap. Think of this as a highly calculated distribution phase. It's essentially a structural liquidity squeeze, engineered by institutional hedgers. What does that mean in plain English? Well, the smart money is systematically transferring all their directional downside risk straight to overextended retail speculators, right at the absolute peak of market valuations. Why? Because they're locking in profits and completely offloading the danger before the music stops. It's a quiet, ruthless transfer of wealth.
And to see exactly how this trap gets set in real time, we're going to break down Master Analyst James Gavarty's exact step-by-step trade plan for the Dow futures. We've got the data, we've got his charts, and we're going to logically deconstruct this entire short setup, literally layer by layer.
Here is our roadmap for today. Part 1, the commercial trap. Part 2, timing the trigger. Part 3, internal market weakness. And finally, Part 4, execution and targets.
Okay, Section 1, the commercial trap, unmasking the smart money. To really grasp this trap, you gotta know the three key players on the board right now. First up, the large specs. These are the institutional trend followers, and right now, they are completely maxed out. Second, you have the small specs. Think of this as the retail crowd, the late-stage buyers who are enthusiastically piling in right at the top. And third, you have the commercials. These are the hedger and producers. They are the distributors, and they are the ones actually setting the trap. Now, zooming strictly into the commitments of traders, or COT pane, which tracks the actual positioning of these market players, you can see the setup just perfectly. Check out the large spec index in blue. They are pinned at a maximum historical index reading of exactly 100.00. Basically, they've deployed all their capital and just lack the capacity to push this breakout any further. Then, look at the green line, the small specs. The retail crowd is carrying the bulk of the risk here, holding a massive 31,125 net long contracts. They are literally buying the top.
But notice this exact number right here, negative 15,699. That is the massive net short position currently held by the commercials. So while retail is busy buying everything in sight, the commercials are just resting on the bearish floor, absorbing every single ounce of that retail buying, actively fading the rally.
And you know why they're doing this? Because the market is structurally overvalued. Gavarty points to the Williams Valuation Indicator, the WIL-VAL-FC, which measures fundamental cost against historical norms. It is stretched right now at a major extreme of 74.67. The fundamental cost of the Dow today is just incredibly expensive. Look, when speculators are completely maxed out on the long side, fighting against heavy commercial shorting at peak valuations, well, a liquidity squeeze and structural unwinding becomes the highest probability outcome for sure.
Moving on to Section 2, timing the trigger, patience over panic.
I want to guide your eyes down to the daily TD sequential count here. It's a mathematical tool we use to spot the exhaustion point of a trend. Gravity points out that we are actively printing a green setup count right now, and as of this moment, we are sitting precisely on bar 7. So the market still needs a little time to print a bar 8 and a bar 9 to fully complete that mathematical exhaustion signal. The trapdoor hasn't quite snapped shut yet. And honestly, this brilliantly illustrates the danger of shorting today versus waiting for Gavarty's execution window in mid to late July. That late July window actually aligns perfectly with the peak of the Williams True Seasonal Indicator. The commercials are intentionally letting the market just grind higher on this seasonal tailwind simply to complete that 9-count exhaustion signal. If you try to short it today, you are stepping right in front of a freight train.
Let's look at Section 3, internal market weakness, the rot beneath.
Let's focus strictly on the underlying cyclical momentum in this pane here. Take a look at the cycle indicators below, the CRSI 15 and the Stochh RSI. These gauge internal momentum. So while the price up top is pushing higher into this rising wedge toward new highs, these indicators below are printing severe bearish divergences, meaning they are pointing down, making lower highs, and completely failing to confirm the price breakout. It's like the engine is sputtering out while the car is still coasting uphill.
To really reinforce this divergence narrative, look right here at the DPO21. That's the detrended price oscillator, which strips out all that long-term noise so we can see the pure short-term cycles. See how it's sloping definitively downward?
It's completely failing right as the price hits that 52,542 local high. This absolutely confirms the waning trend. The directional conviction of this entire upward move is just hollow.
So let's summarize this evaporating internal pressure. The daily setup counts are fragmenting. Short-term directional conviction is totally stalling out. But even more concerning, look at the Williams Progo and Williams pressure indicators. They've crashed all the way down to 46.86 and 30.58 respectively. These specific drops reflect a pretty harsh reality for the bulls. Institutional capital is abandoning the market, leaving retail traders completely unsupported.
Bringing us to Section 4, Execution and Targets, Springing the Trap.
All right, so here is the crucial part, the mechanical execution. Gaverty lays out a really precise fixed position trade plan for the Dow futures. The entry zone sits right at overhead resistance, between 52,500 and 53,000, timed exactly for that mid to late July window as that weekly 9 count finally completes. Your stop loss? A mechanical buffer set at 53,150. Why there? Simply to keep you safe from those unpredictable final stop hunts. Then we've got 2 distinct unwinding zones for take profits. First at the 50,000 zone, and then down at 48,260.
Now I want to burn this exact number into your memory. 50,152. This is the primary on-chart green line support, according to Gaverty's analysis. This level marks the official start of the primary unwinding zone, where all those overextended retail longs are going to start getting flushed out.
And then right below that, we have 49,804. This is the secondary on-chart red line support. What makes this target zone so incredibly high probability is how it merges just perfectly with the macro 49,899 Fibonacci retracement right around that massive 50,000 psychological level. The confluence here is just undeniable.
To anchor this ultimate payoff, Gaverty notes, the dominant 128-day and 234-day composite cycles map a localized peak right around early July, projecting a steady downward phase extending through August. This perfectly cements the rationale for that post-July execution window. The cycles, the internals, and the smart money are all pointing to the exact same seasonal flush.
So we've decoded the commercial trap, we've identified the institutional abandonment, and laid out the exact execution parameters. The writing is clearly on the wall, and the setup is mathematically primed. So I'll leave you with this final thought to consider. When the structural liquidity squeeze finally hits, will you be the one left holding the bag, or the one springing the trap?